Welcome back to Capital Crew. Today, we have an exciting topic to discuss: how to invest $10,000 right now. As seasoned investors, we understand the challenges investors are facing in today's market. There's inflation, rising interest rates, geopolitical tensions, and many other factors contributing to a wall of worries. But don't worry, we've got you covered. Year to date, most asset classes are benefiting from expectations that the Fed's tightening cycle is close to an end. If that assumption proves correct, gold may be one of the prime beneficiaries. Gold tends to trade with real or inflation-adjusted interest rates and the dollar. If rates, particularly real rates, and the dollar are falling, gold is generally rising. The odds are that the Fed is reaching the end of its tightening cycle. If this proves true, flat to lower real rates should help gold, even more so if sticky inflation in Europe forces the European Central Bank to continue to raise rates, further pressuring the dollar. Assuming growth and inflation continue to soften, gold can continue its ascent. Memory semiconductor stocks trade at significantly lower valuations compared with technology sector leaders. This presents an attractive opportunity for investors to capitalize on the industry's growth potential. The demand for memory chips is rapidly improving, especially in sectors like electric vehicles and AI applications. High-performance AI server chips require powerful memory such as high-bandwidth memory (HBM), which enables the processing of vast amounts of data. Major tech players such as NVIDIA and AMD recognize the advantage of increased memory capacity for enhanced performance of large language models or LLMs. The demand for memory content is rising due to the increasing prevalence of AI servers and the integration of more memories into advanced AI server chips. We expect US and global economies to fall into recession later this year as the impact of higher rates limits credit availability. Slowing growth will likely see headline inflation fall, boosting the outlook for US Treasury bonds and defensive equities. With inflation coming down and activity slowing, 5-year US Treasuries, which currently yield about 4%, look attractive. Consider gaining protection to the low level of risk priced into the market by buying a volatility-related ETF. Tighter bank lending standards and the rise of non-bank financials such as private credit, private equity, and fintech may lead to market volatility by year-end. Diversify away from stocks and bonds into something that can do well in times of stagflation. Consider managed future funds focused on macroeconomic trends, which can tap opportunities in asset classes that move differently from stocks and bonds. Managers in this space tend to use rules-based systematic approaches to find developing trends in various global asset classes. Stagflation-like consequences have already impacted equities and bonds. Valuations and breadth in stocks are currently at fragile levels, and most government bonds are back under pressure. Thank you for joining us today. We hope you found the insights from our experts helpful in navigating the current investment landscape. Remember, in times of uncertainty, diversification and small investing are key. Whether it's gold, memory semiconductor stocks, hedging strategies, or uncorrelated assets, there are opportunities out there. As always, do your research, assess your risk tolerance, and make well-informed investment decisions. Stay tuned for more exciting discussions on Capital Crew, and until next time, happy investing!